Well, everybody knows about the A team. At the Revere, the host A team is Danny. I'm the B team today. He's actually in Florida, taking in his daughter before she starts college. Wanted to check out Florida one more time, so we gave Danny the day off. How kind was that of us, Zach?
It's very big of
Zach,
us.
our man on the street.
Yes, happy to be here.
All right, glad to have you. So today's podcast is going to be pretty focused on the markets, charts, and interest rates, the dollar, and what's going on with seasonality and some breadth issues and sentiment. And we are going to get right into it. And I'm going to show three charts to kick off. And the one you're looking at right now is the S&P 500, and I've got let me blow this up just a tiny bit. I've got an arrow pointing here toward what I've been calling in the nightly videos a shot across the bow. This happened last Thursday, so 7 trading sessions ago. We had a new high and then a big negative reversal. The next 2 days acted like that big negative reversal didn't even happen. Then we had a consolidation day. But then after that third day, we had the Fitch downgraded the U.S. Credit rating. And if you read what Fitch said, you really can't argue with it. It's really about how our budget process is broken. There's polarization, blah, blah, blah. We have a bunch of unfunded liabilities that nobody's discussing. And they're right about all that. Of course, the ratings agencies have no credibility either after what they did by marking all those mortgage bonds as AAA back in the financial crisis when those were really belonged in a flaming dumpster. And we all know how that turned out. So you've got two dysfunctional agencies fighting with each other. How's that going to end, Zach?
Not well, Don. I don't think that'll end well for anybody.
Well, it hasn't been well for the market the last 3 days. Now, we've been in a very nice uptrend. If you've been listening to the nightly videos, you're well aware of that, and we've been taking advantage of that. But this green line on here, the 21-day moving average, the entire positive trend that we've seen over the last 2.5 months took place above that green line. Yesterday, 2 days ago, Wednesday, we closed right on it. Yesterday, we broke below it. Today, we're rallying a bit and trying to get back above it, but this is a very critical level. It's about the 45.10 level on the S&P 500 right now. We're 15 points above that. That could, if we just started this podcast an hour ago, we were below it. So quite a bit of volatility there on the S&P 500. Let's look at the NASDAQ 100. This has been getting uh, it's been lagging on a relative strength basis. This is the big 7 tech stocks. And last night, Apple reported and not so well received, down 3%. However, Amazon picked up the slack by knocking the cover off the ball, and they're up 11% on their earnings report. So we had 2 closes below that key 21 level on the NASDAQ 100. That key level right now is around 375.80. We're trading at 377 right now, so trying to get back above and stay back above there. And this is really our dividing line between a short-term caution and a short-term uptrend. And we're kind of playing ping pong above that level over the last 3 sessions. So we'll see how we close the week. Will the Bulls win? Will the Bears win? We don't predict. We just see what action the market is taking, and we react accordingly. We've had a lot of leading stocks take it on the chin. It's been a very interesting earnings period, and some really getting hit hard, others really taken off to the upside. So it's always a mixed bag with earnings. We measure our risk for anything that we have going into earnings, um, but for right now, part of the focus is the dollar. So I showed the NASDAQ 100. I showed the S&P 500, and the dollar is very critical. A strong dollar is not good for the market. So this dollar going higher over the last 3 weeks corresponds with a little bit of weakening in the market. But you can see the dollar down today. We had a jobs report before the opening. It was weaker than expected, and the prior 2 months were revised downward. That, ironically, is a good sign for the overall market because it means the Fed doesn't have pressure to keep interest rates higher for longer, and the dollar coming off. And let's go to interest rates. This is the 30-year bond, TYX, and it had taken off. It had three big moves up over the prior 3 days, and this corresponded with that credit rating move by Fitch. So we broke out, and higher interest rates are not good for growth stocks. But with the weak jobs report today, you can see interest rates taking a little bit of a break. With the interest rates taking a break today, we can see, as I showed before, that the S&P 500 is trying to regain this key level. So there's a very big correlation between what's going on with the dollar and interest rates and what's going on with the market over the past 3 sessions. So we're paying closer attention to that. We always want the wind to be at our back and not in our face. We've lightened up some positions as we've locked in gains and had some stops taken out. But uh, for now, all it is a short-term caution, short-term correction. Longer term, the market trending above the 50-day moving average. That's our intermediate term, excuse me, trend line. Above the 200-day moving average. That's our long-term trend line. Recall we spent the majority of last year below that black line, the 200-day moving average, and that's the dividing line, a healthy market and a risky market. And once we got back above that level and started trending higher back in the middle of March, 329 was the key day. That's when we had what's called a follow-through day, and it's kind of a signal to re-enter the market based on William O'Neill principles, which we're big proponents of. So since then, you can see the market trending higher. This is the first pullback during that period that tested the 21-day moving average. We'll see where we are by the end of the day and the end of the week. But as far as whether or not we should have, we let the health of stocks and of the indices dictate how we approach the markets. If you watch the videos, you're familiar with, let me bring in the everybody's best friend, the trend gauge. So every night we show this on videos. It dictates how market leaders are acting and then how the 5 major indexes are acting relative to their short-term 21-day exponential moving average, their medium-term 50-day moving average, and their long-term 200-day moving average. And depending on how these arrows are configured and whether or not they're under pressure or threatening to go more towards neutral, that dictates how much money we have in the market. So between the trend gauge and also the tail of the tape, every night we discuss something called our portfolio volatility adjusted beta. And for comparison, the S&P 500 has a 1.0 volatility adjusted beta. That's the baseline that every ETF, every stock that we own is compared to. And what we're trying to do is determine the exposure and the overall volatility of the portfolio. So we got a mailbag request come in from a client, and I'm going to paraphrase that. I don't have it right here in front of me. I said, well, wait a minute. Dan did send it to me. Hold on one second.
Love the mailbag.
The mailbag. You got to love the mailbag.
Love the mailbag.
So TS wrote in and said, I may have missed the reasoning, but I'm curious as to why in a bull market we are only 53% invested in this time. Thanks. So Dan replied back, thanks for reaching out. Whenever you have a question, you can email me directly. The beta, the adjusted beta of the portfolio is different from the cash balance. You actually have a beta over 1 relative to the S&P 500. Those are the numbers that I just showed. I think when this came in, we were at about a 1.7. Dan says you have a 32% position size in SSO, which is 2 times the S&P. Therefore, you have to add 32% more equity, bringing down your exposure to 21, or your cash to 21%. Then our stocks have a higher beta than a 1, so that would bring it down as well. We also keep 10 to 15% cash even in good markets for opportunities or hedging. In a bad market, the cash level would be significantly higher. So cash percentage and the risk of the overall portfolio are related, but they're two different measurements. This is especially true when using leveraged ETFs in order to keep cash available for other investments. So I'm going to bring in this chart and explain what Danny was saying in that email. So this chart has three levels, or three sections to it. The first section deals with the S&P 500 and how risky is the S&P 500. I'm sorry, how volatile is the S&P 500? We know the S&P 500 always has a beta of 1, and the volatility factor that we assign to it is 1, and that's because this is the baseline of the market. And beta is a often quoted risk and our volatility correlation to the S&P 500 of every instrument. If it has a beta of over 1, it is expected to move higher over the long term than what the S&P would do, or lower if its beta is more than a 1. So in other words, if the beta is 1 and the S&P was up 1%, and your beta was 1.5, you would expect on that day or over the average that the return for that instrument be a 1.5. So right now we track the overall average true range. That's what is the high to the low of the S&P 500 on a particular day. And we look back over the prior 6 weeks trading sessions, and right now the average true range of the S&P 500 is basically 0.8, so less than 1%. It was over 3 times this back during the bear market of last year. So the market on a daily basis was 3 times more volatile than it is right now. So move over to the middle section of this chart, and this is where we calculate what we call the Revere Volatility Factor for everything that we own. So the first, we need 3 pieces of data for this. We need the beta of the overall instrument that we're looking at. Let's use NVIDIA for an example. NVIDIA has a 2.1 beta. So it's 2.1 times, if the S&P was up 1%, you would expect NVIDIA to be up 2.1%. If it was down 1%, NVIDIA should be down 2.1%. The price of NVIDIA, and then the average true range, or how NVIDIA moves from high to low on a daily basis, is currently 14.4%. So you divide that by the price, and that gives you a daily average true range of 3.16%. So let's compare the ATR of the S&P 500 at 0.79%, the volatility of, or the average true range of the S&P 500, 0.79%. Okay, so basically 0.8%. Compare that to NVIDIA, it's 3.16%. So that's over 4 times. We take the volatility of the ATR of NVIDIA, and we divide it by the volatility of the S&P. So on a daily basis, NVIDIA will move 4 times high to low as volatile as the S&P 500 will. And then we use 75% of that calculation and 25% of the beta to calculate what we call the Revere Volatility Factor. So NVIDIA gets a score of 3.53. We sum all the scores of everything that we own, and this brings you to the third part of this calculation, and it's called our overall portfolio volatility adjusted beta. So basically what we're doing is we're taking the position size that we have in everything that we have, add the calculations up, and we come up with a number that tells us how volatile the overall portfolio is. And in this example, it's at 1.26. So 26% more volatile than the S&P 500. So the expectation is if the S&P was up 1% on the day, that our portfolio should be up 1.26%. If the S&P was down 1% on the day, our portfolio should be down 1.26%. Below there, we have a cash calculation. So at this point, we've got 10% in T-bills. That leaves us 90% to invest. And we've got a total of 28.8% cash. So in other words, of that 90%, we've got 62% in the market. So you add the cash level of what we have available to invest, you add the cash level of the T-bills. Right now, we're the equivalent of 38.8% in cash. So it seems like we've got if you just look at a pure cash basis, seems like we have a lot of cash and we don't have that much in the market, but actually we have more volatility than the market currently has when you factor in the volatility of the overall holdings. Now, I hope that wasn't too complicated. Let me sum it up in a couple of sentences. First of all, we take a look at the volatility of the S&P, and that's assigned to 1. We take a look at the volatility and the beta of every position that we own and assign it a score, and that score is on a relative basis versus the S&P 500 from a beta and volatility standpoint. We sum up those scores, and that gives us the current volatility of the overall portfolio. And this gives us a benchmark with the S&P being at 1.0, the volatility of the portfolio in this case 1.26, so 26.1% more volatile than the S&P, despite the fact that our cash that we have available is 39%. So we're basically 61% in the market. Zach, does that make sense to the man on the street?
I think I was able to keep up. The points at the end were particularly helpful. I appreciate the summary.
Good, 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 good. So I think that answers the mailbag question, and I think we're going to dive into the market and then our segments now with the fellas. So
Perfect.
let's start off. Actually, I think I pretty much covered the market and what we're looking at with the S&P 500, the dollar, and interest rates. So let's segue into what the fellas are going to talk about this week, and we're going to start off with Ted. Teddy 10 charts. Take it away.
Yep. So this breadth data was taken as of yesterday's close, just to let you guys know. So the markets are currently in the middle of a pullback. To what extent is always uncertain, but I'm just going to present some breadth data once again. So here is the S&P 500 weekly chart. The advanced decline line of the S&P 500 and the NASDAQ are pulling back as expected, along with the general market. The next one is the NASDAQ weekly chart, as well as its corresponding advanced decline line. This one, this one again, it could barely hook up from its bottom, so there's still a lot of room for improvement here. That's definitely a negative divergence. As you can see, the price of the NASDAQ blew by its February highs, but this one's still yet to make those highs, get over those highs. The following two charts is the NYSE and ASI, the McClellan summation, and the net highs. My bad. The NYSE, as of yesterday's close, did not make net low territory, which is definitely a good sign. We're not seeing new lows, which is a positive, even though we're pulling back. The next one is the NASDAQ net high and low chart. This one dipped back into net low territory. However, if you look from left to right, net lows are contracting, and then net highs are expanding on balance. So now we want to see these to be contained within this range, find some stabilization in the markets, and then see net highs once again. The next two charts, this one is the NYSE McClellan Summation Index. We hooked lower and below the 10-day moving average. So that is usually an indication it's like a yellow light in a way. So, and then the next chart after this one is the NASI, and it's the same signal. It hooked down as well below the 10-day moving average and the parabolic SAR. So it's just another indicator to tell us to maybe slow down, step back, reevaluate, and then look for new setups. The following two charts are the percentage of stocks above the 50-day moving average, 150-day moving average, and 200-day moving average. And also, as expected, if we're pulling back, the numbers will come down as well. 2 weeks ago, I noted that the percentage of stocks above the 50-day moving average was getting near frothy levels. As you can see, there's a bunch of peaks at the very top, and rightly so. We're pulling back now, as well as the percentage of stocks above the 50-day moving average. However, these numbers are still very healthy, so we just have to wait it out and see what the market gives us. Like I said, here's another negative divergence with the Nasdaq. The percentage of stocks above the 200-day wasn't able to make a higher high above that February level, even though price did and is well above it. And so that just kind of indicates that breadth is still not where we want it to be, and we're getting a pullback now. So if we find support here and then see that percentage of stocks above the 200-day blow by the February highs, that would be a very good sign. Finally, I have two sentiment charts. The first one is a CNN Fear and Greed Index. We're definitely coming off those highs from extreme greed and dipped back into the greedy territory, which is good to see sentiment light up a little bit. And then finally, the last chart is the AAII. And in the previous weeks, I've talked about how we've been pegged at this frothy level, and it seems like we're finally lightening up a little bit in terms of sentiment on the bullish side, as well as price in the markets correcting below the 21 EMA currently.
All right, so once again, sentiment as a contrary indicator seems to have worked out here. Thanks, Ted. Teddy 10 charts. From Teddy 10 charts, we'll go to Connor, who's got 3 charts for us to look at today. Take it away, Connor.
Yeah, so I think it was a good time to talk about seasonality today on the show, and just how it's something we look at, but it's clearly not something that means that much. You take it with a grain of salt, because there's always that saying, "Sell in May and go away," and the market didn't care about that. But historically speaking, it's something that's good to keep an eye out, and it's something we're always well aware of. So right here is a chart. Carson's research put it out, and it basically shows the week performance in August and September for the S&P index. So historically, going back to 1950, August has been slightly green, and then September's been very weak. But as you look, if you can weather that storm, look at October, November, December. So, and we're already kind of seeing it. August has already been somewhat off to a weak start. We're pulling back. We broke the 21 EMA and whatnot. So you could argue already seeing some weak seasonality come into play in the markets. So yeah, this graphic does a good job of showing the strength of each month's good visual.
Good. It really, as you mentioned, Connor, the sell in May and go away isn't necessarily you miss the typical gains that happen in mid-June and all in July. So how about if we say this? How about sell in May and go away, come back in June to stay in tune, sell in July, or your profits go bye-bye?
Whoa.
That to catch on, do you think?
Wow.
Yeah.
Don's the best with those.
I'm a poet,
Yeah,
and I
you got
didn't
it.
even know it.
Oh,
Let's
yeah.
see Dan come up with a rhyme like that. I know he's the A team, but do you think he can beat that, Zach?
No.
All right, let's go through that one more time. Sell in May and go away. Come back in June to stay in tune. Sell in July, or your profits go goodbye.
Wow. Not bad.
I'm leaving them speechless.
Yeah,
I love
that's
all
it.
right.
Yeah. Somebody write that down.
Next chart, Connor.
And yeah, so this
Here we
is
go.
Yeah, so this is the Russell. So pretty much the same thing. This is just a different graphic to look at the seasonality. So like you said, we exactly what the market saw, a strong run up in July, and we're pulling back into the start of August. Seasonality shows that you pull back in the first week of August, and then you kind of consolidate. So you could use this as a guide. find those short-term lows and see if the market can hold those. And as you can see in this, into the end of August, the market ramps up, and then into September sees a huge push before a brief pullback in October, and then October through December has historically been
Yeah,
pretty strong. So
yeah, that's interesting. So quite a divergence in September versus versus the S&P 500. So really, you've got a big divergence in small caps versus large caps, especially in September. August, it seems to be unanimous to just tread lightly. So I guess those are the dog days of summer that they like to talk about in the market. All right, last
yeah,
chart here. So
and
this,
yes, this is the S&P again. Pretty similar like that first graphic I showed. And what you can gauge from this is that, market might pull back, but into November, December, the markets historically are pretty strong. So something to keep an eye on. And looking back at June, July, the markets have been very strong. So they have been following the
yeah,
seasonality route.
and what's interesting about this chart is, and this goes with the Russell too. So I guess I want to take back what I said about small caps versus large caps, because you can see how different the middle of September is versus the beginning and the end. The last couple of weeks in September are really the time is really the time to avoid. But that first chart that you showed is just the gross monthly returns. So it doesn't show that big spike up in the middle of September before the last couple of weeks into the end of the quarter is a sell-off. So, if you're a little bit more nimble from a seasonality standpoint. August, it seems to be unanimous. It's tough, but September, you've got that big spike before the sell-off, which leaves you lower than you were at the beginning of September. And of course, remember, this is an average. This is an average over decades. Doesn't necessarily mean this is how things have to go. Although it's kind of been pretty spot on this year from a seasonality standpoint with the March rally and then the July rally. All right, Connor, anything else to add?
Nope, that's it for today.
All right, now for the guy who puts the fun in fundamentals, our very own Michael Ramos. What do you got for us this
Okay.
week, Mike?
Yeah, so I got a couple things, but I wanted to start off with something interesting I saw in the Wall Street Journal this morning, and something I've been thinking about for a little while too, is that there's an article about Bud Light and how the boycott is eating into Anheuser-Busch's share of the beer market. And something I've been thinking about is a lot of these companies, like you've seen it with Target, you've seen it with Bud Light. It's this virtue signaling, and they seem to take it upon themselves to kind of dictate what the public should be interested in and focused on, and what they should believe. And you know, without getting political about it, I mean, anyone can have whatever views they want. Everyone's entitled to their own opinions. But I was thinking an analogy that makes a lot of sense, and I also agree wouldn't be acceptable. Is if let's imagine if Ford in the new F-150s on the dashboard they had a big cross on every single truck and released it. The public would be outraged. They'd say, "Why are you putting your religious views and selling them in cars? Like, you can believe whatever you want, but we don't have to see it every day. Let us believe whatever." And it's kind of the same thing that Target and Bud Light and all these companies are doing. Why should in a store? Why should Target be selling merchandise and having certain pride flags and certain things around their stores? Like, for example, I remember in school you weren't allowed to say, like, during the holidays, you weren't allowed to say Merry Christmas or Happy Hanukkah. You couldn't get religion involved at all. So why is it okay now in schools to promote certain things for little kids and talk about sexuality and sexual preferences. So I just think it's a double standard, and as we can see now, these companies are taking a hit, and it's kind of backfiring on them because it's, as I said, everyone's entitled to their own opinions and beliefs, but it's a line that you shouldn't cross to project that on other people, and the public is kind of getting fed up, and it's nothing to do with homophobia or anti-religious views. It's just like, let me do my own thing. That's the point of living in a democracy. You're kind of allowed to live however you want. So I think that's kind of where it's coming from, and I don't agree with a lot of the positions that these companies are taking. And like in the article, they even say people just want Bud Light to stick to selling beer, and people want to enjoy their beer without a debate. And I completely agree with that, because that's why you're drinking a beer, to just have a good time with friends. It doesn't need to be a virtue signal. It doesn't need to be this debate. So I just saw that article and wanted to share some thoughts on it, and be interested what our viewers believe, if they agree, or maybe I said something that people don't agree with. So I'm totally happy to hear other perspectives and thoughts on this. And then something else I wanted to get into more now, focused on I guess the market specifically, is sort of the kind of analysis I do, and in terms of fundamentals, what attributes you want to look for in a company, and what the best businesses possess. And there's a few key characteristics, and I'll list through them and then give an example of a company that fits, that checks pretty much all the boxes. And the first is strong barriers to entry. Then you want to have limited capital requirements, organic growth, repeat customers, significant pricing power, goes along with that strong barriers to entry, high margins, low risk of technological obsolescence, competitive moats, also tied into that strong barriers to entry, and strong, sustained, and increasing cash flows. So a company that I've recognized, and I'm not the first one to do this because a lot of people have recognized it, that's why it's been such a strong performer, is Domino's Pizza. And Domino's, the best investments are usually the most obvious ones. And Domino's Pizza is a franchise business model. And because of that, it produces some of the highest levels of return on capital, which goes to that high margins and limited capital requirements, and also the strong and sustained and increasing cash flows. So if you think about the business model, most of the capital for a franchise is provided by the franchisee. So the franchisor gets a royalty from the revenues generated by other people's capital, which is an amazing business model. And unlike other fast food restaurants, and this is something really, really special and something I hadn't appreciated until I started digging into it, unlike other fast food restaurants, Domino's focuses solely on the food, but the best part is that they're predominantly a delivery business. And what that means is that they can operate from cheaper locations, therefore cutting the capital required to operate compared to other fast food restaurants and operators that are competing for the best locations, and therefore have higher costs. And this partnership with Uber, before they released earnings, they gapped up on that partnership with Uber. And then after earnings, they continued and held that move. But part of what makes Domino's so special is that they can set up shop in a very, very cheap location, because the vast majority of their business is deliveries. So it's not that important for them to have a great customer experience at the location. And in the future, with more automation and delivery and this partnership with Uber, they can set up in even cheaper locations and cut down on staffing costs, and just have robots basically making pizzas, because it's not that hard to make a pizza. So in terms of strong barriers to entry, they've been around since 1960. It's very difficult to set up a franchise at the scale that Domino's has. There's a few competitors, but I mean they've kind of got a lock on the pizza market. As I spoke about, limited capital requirements, a lot less capital because of the franchise model and because of their reduced spending on locations versus other fast food restaurants. Organic growth. Um, People love pizza. They keep eating more pizza. They don't have to do a lot of acquisitions. I mean, it's basically the same brand expanding to more locations. Repeat customers, significant pricing power. They can. I mean, it's difficult. They can't increase prices too much, but they do have the ability to increase prices if they need to cut down on costs. High margins. They've got, if you look at their return on capital, they've got some of the best return on capital in the game. And if you look at return on equity, which MarketSmith shows, that can be a little misleading. This is why you need to dig into the companies a little further, because in terms of return on equity, it's even better. They've got like some of the most incredible return on equity, but that's because they're a pretty highly levered business model, which means that they have a lot of debt, and they actually use that debt wisely because they're able to secure financing and this long-term debt at really, really low rates. And then they use that to actually pay a dividend to reinvest in the business. So debt for a company like Domino's is a concern if they're not able to pay it off. But if you look at their free cash flow, they generate more than enough free cash flow to pay off that debt. So it doesn't seem to be an issue at the moment. And yeah, low risk of technological obsolescence. They're not at risk of some new tech company coming and taking their market share. There's no new iPhone or product that's going to put them out of business like BlackBerry. And technology, as it progresses, will actually benefit them. So that's the kind of thing you want to see in a really strong, sustainable company. And as you can see in this monthly chart, I mean, they've been one of the strongest performers in the market over a decade. So
Yeah, they absolutely nailed the mobile experience with their app. They were light years ahead of similar of their competitors. That Pete the Pizza Maker app, when I order Domino's, it's just amazing. It's so simple to go through. It's got every base covered, and what an amazing move the stock made after the financial crisis, basically going from $10 a share to 600. Gave back a good bit of that last year during the the bear market, and also them the pullback coincided with the rise in the delivery services like Uber Eats, because you know before, if you wanted to get food ordered, you had to stick with the delivery companies. Well, all of a sudden Uber Eats would pick up anywhere, and DoorDash and companies like that pick up anywhere and bring the food to you. And then Domino's said, hey, if you can't beat them, join them, and made a partnership with Uber Eats. Was it Uber Eats that they made the partnership with, right,
yeah,
Mike? Okay.
yeah,
So a great great response to their most recent earnings report on the back of that partnership that they had. So definitely an example of forward thinking. They were ahead of their time with that delivery app. I believe, Zach, that is going to wrap it for the day. Zach, any questions or takeaways from anything you've heard the fellas say? As our man on the street, we certainly want to know what Main Street thinks about what we're putting out there.
I do have one question. It may be irrelevant. I'm not sure if we covered it. But before the show, I had asked the fellas if they had any thoughts on what should go in the thumbnail this week. And Mike mentioned Tim Cook. And was Apple mentioned in there? Because I was curious what they got going on. I don't know, an iPhone. Think about upgrading.
I take a look at the Apple charts. I don't know if I mentioned this or not. I know we've talked about it extensively, but this is the first time Apple's taken a break after their earnings report, gapping below this 50-day moving average. That's the red line. So they're kind of taking a little bit of a break from a relative strength standpoint and a price standpoint. on the market, as their earnings report was nowhere near as well received as Amazon's was. You can see Amazon gapping up to new highs on there. Is it new highs? Let's take a look at a weekly chart. No, not anywhere near new highs, actually. So Amazon's got
Yeah, new
room to
52
run. In
week
fact,
highs.
it's new 52-week highs, right? But coming into a resistance area from when they were hitting on all strides, going back into the 2020s. But basically, from what I've read, great earnings report by Amazon, Apple. Not so much, but they're getting ready to have the new iPhone coming out. They got to get rid of their Lightning charger and replace it with USB-C because of Europe demanding all devices have a common charging component. So that's going to be pretty simple. Their Lightning charger was one of the things that set them apart from the Android phones, but uh, Eurozone said not so fast. So be curious, always curious to see how the Big Seven is acting, as there's such a big weighting in the market that we always got to be aware of what they're doing. But for the thumbnail, Zach, if I mentioned this to Danny, if you can find a bull on a surfboard, that's really the way we play the market.
Bull
Is
on a surfboard. All right. Yeah, I'll
bull
look.
on a surfboard. We take a look at the market every day. We take a look at what's acting well and what's not acting well, and uh, you're very familiar now with being below the black line is an unhealthy market. That black line's the 200-day moving average, but the end of March we got back above it. And if you're a bull and you're sitting in near the shores of the Atlantic Ocean and you're on your surfboard and you're paddling and you stood up, you would have been riding the wave uh, and not quite reached the shore yet. Maybe on a short-term basis, you're losing your balance a little bit, but above the medium-term 50-day moving average, we don't even blink about the fact that whether it's a bull market or a bear market. So, and we treat stocks the same way. That the 50-day moving average is an excellent entry point. Sometimes for stocks. Sometimes it's a 5 or 6% pullback from the indexes to get there, but when you get there, it's a good low risk entry point. And if you fail at that level, notice how we tested it back here in April, the beginning of May, the end of May. Testing that red line, the 50-day moving average, but every time in this case this year, it was a buying opportunity to get on board. So we're pulling back now. Are we going to make it all the way to that red line? We don't know. We don't predict, but we let every position that we have be judged on its own merits. We've got a thesis for everything that we own, but if the price doesn't match that thesis, we're not going to override the technicals. So we buy on the fundamentals and technicals, but we sell only on the technicals. And if a stock's breaking down, it doesn't matter what you think about it. Like here's a good example. Fortinet was one of the preeminent cybersecurity companies, riding a nice uptrend from its last earnings report. And this is kind of amazing how just in a 3-month period, the perception of what a company is doing can change so drastically. On their last earnings report, a big beat and a raise, and the stock went from 60 up to 80. So a 33% move. Today, they're down 23%. 3 months later, apparently their business fell apart, or what they're looking at in the next quarter is not as bright as they thought it was going to be. You can see the numbers here. 2023, they're going to have 27% earnings growth. Next year, that's dropping to 2%. We don't want to invest in stocks, especially if they have a 51 PE that's showing a decrease in its earnings. So overnight, Fortinet went from one of the leading security stocks to a get the heck out of the way stock. And look at the volume. This is not your uncle or your next door neighbor selling their shares. 704% above average volume. This is institutions saying, "Yeah, get me out of Fortinet." And note where it broke below, Zach, that magical black line. This is an avoid, absolutely.
Mm.
So that's just an example of what you can have from one earnings report to another. And hey, if you can find a bull on a surfboard, I would go for it.
Yeah, I'll get the graphic
Actually, I'll
guys
bet you
going
can
on it.
find a surfboard, and I'll bet you can find a bull, and
That's
you can
what I
take it from
think.
there, right?
I think I might have to put that together. Yeah, I don't know if anybody's
All
got
right,
bulls on surfboards out
all
there.
right. That's what we're going to see, folks. All
Perfect.
right. So, if you like what you heard, tell your friend, tell your neighbor, send them to revereasset.com, and we'll see you next week on Your Money. Because it's not how much you make in the market, it's how much of that you can keep.